By late 2025, China's crude oil inventories reached an estimated 1.4 billion barrels. Set against imports of 11.5 million barrels per day, this volume provides roughly 120 to 130 days of import cover, the largest emergency stockpile in the world. This buffer sits well above the 90-day benchmark the International Energy Agency requires for its members, providing a level of energy security that exceeds most advanced economies. Despite its scale, the exact size of this reserve is an estimate. Beijing treats its specific inventory levels as strategically sensitive and publishes no official data. This lack of transparency forces the global market to rely on secondary observations, ensuring the true capacity remains a moving target. The system has two layers. First, the official State Petroleum Reserve, government-controlled tanks holding roughly 360 million barrels. Second, a larger layer of commercial stocks held by refiners and state companies, totaling an estimated 1 billion barrels. Since Beijing mandates these companies maintain emergency reserves, this commercial inventory functions as a secondary strategic buffer that the state can tap during a crisis. China accelerated its accumulation throughout 2025, adding an average of 1.1 million barrels per day. This aggressive buildup used softer global prices to push the stockpile far beyond the international 90-day floor. For any observer tracking only China's official government tanks, this combined system hides nearly 1 billion barrels of strategic capacity. To calculate these levels, agencies like the EEIA must reconstruct the stock from satellite imagery of tank roofs and observable trade flows. The days of supply result depends entirely on the denominator. Measuring against 11.5 million daily imports suggests 130 days of cover, but against 16 million barrels of total consumption, that runway shrinks significantly. This variance creates a permanent margin of error, making the exact duration impossible to confirm. Keeping the true duration unreadable prevents rivals from knowing when Beijing will be forced back into the physical market during a price spike. The 2026 Strait of Hormuz disruption moved this strategy from theory to practice. As global flows stalled, China's years of accumulation provided a critical cushion. Beijing kept its domestic refiners fully supplied by drawing exclusively on its commercial inventories, leaving the core State Petroleum Reserve completely untouched throughout the crisis. This tiered approach allowed China to avoid buying oil on the spot market when prices were at their peak, effectively bypassing the most expensive phase of the disruption. The 1.4 billion barrel stockpile grants Beijing the physical capacity to outlast a blockade, and the geopolitical leverage to ignore market pressure until it can trade on its own terms.